So we got these easements. We got them all. Now, do we need them? How can we get rid of them? Now that they're recorded, we've been using them for 20 years. What are the reasons we need to get rid of them, right? So we're going to need to get rid of these somehow. Okay, so there are some things in place that we can get rid of. We can terminate them, all right? So the first one is that the purpose no longer exists. So if I have the dominant tenement and I've been using this back road and I built a roadway out on the other side of the road, making it easier for me to get to the main road, do I need that road anymore? No, right? So we can just extinguish that easement, and we'd have to do it through getting an attorney involved and having it written out of the deed. But we can do that, right? The purpose no longer exists. Second thing, what if I'm the dominant and I go buy the neighbor's property, and now I own both pieces of property? We have one big one instead of two small ones. Do I have an easement anymore? No, I don't need an easement. It's one big happy property, right? So we don't have two different people doing that. So we merged, right? We recombined them. If I'm the dominant and I just say to the servient, I don't really need that. I don't want that anymore. I'm not going to use it for whatever reason. I can just sign a release, say I'm not going to use it. Right? If over time, let's say I move and my house becomes abandoned or empty for years and years and years, it's abandonment. Nobody ever uses it. And when they do come back, I use another way in or another way out. Maybe they build a road or an entryway. All right. So abandonment, if it's not used, we can do it. If we have an easement by prescription and then all of a sudden somebody says, I'm not going to use that anymore. I'm not cutting across your property. Or we're going to cut across your property to go to the lake, and then all of a sudden the lake dries up and we fill in the lake. There's no more lake. So we have no more use of it, no more prescriptive easement. All right. We don't need that. Now, the last one here has really not a heck of a lot to do with the easements, but understand that if there is a party wall between the two properties, if we have a party wall, they get to use their side of the wall, we get to use our side of the wall, right? We both get to share that wall, right? They have the right to that use, okay? So a lot of these are pretty much obvious, right? They're not, I mean, if you think them through, none of these are shocking, right? They're all pretty straightforward, So let's talk about a license. Now, you've got a driver's license, you're looking to get a broker's license. If I give you a license to fish my pond on my lake, right? That is a personal privilege. That is a privilege that can be terminated or revoked, right? Real estate commission can take your license, right? Law enforcement can take your broker's license. Law enforcement can take your driver's license. If I don't want you to fish my lake anymore, I can tell you to go away. Now, another one, now this is not an encumbrance by any means. This is a personal right, a license. Any of you, I'm sure that somebody has gone to a concert lately or a ball game or anything else that has a ticket. Read the small print on the tickets. And I know most of us get e-tickets now, but there are details. Read the details. And in the details, what it says is this is a license, right? It doesn't say it's your right to go to that show. It says we're giving you a license to come to our arena. And if you act a fool, guess what I can do? I can throw your sorry rear end out, right? Same thing with a cruise contract. You go on a cruise, it is a license. They can put you off at any time. Airlines, license, right? They're not obligated. If you do something that says that they can throw you off, they can. They're within their rights to do so, all right? So that is, they're not encumbrances, but they can be terminated or revoked at any time, okay? Now, it also, if you have if I have the lake and I let you use it, and I die, does the next person have to let you use it? No, No, next person doesn't have to let you use it. Okay. If I sell the house, does the next owner have to let you use it? No, it dies with me. It dies with me. All right. So again, licenses are a little different than easements in gross. These are personal. Okay. These are personal. Has anybody ever heard of encroachments other than a football game? Right. An encroachment is when you build over the line. Instead of getting a survey done on your property, you never got a survey done, and you put a fence up. Turns out the next survey that gets done on your neighbor's house who's going to sell it finds that you're 3 feet on his property. So who is going to have to pay to have that removed? You are. You are. You're going to have to get it paid. You're going to pay it. All right. So that's why it's really important. And we're going to stress this as we go through. Too many of us as buyers overlook the fact that we need a survey. Oh, why do I need another $500 survey? It's just going to take some time, all that other stuff. Well, if you have a survey and if it was, they find something, or if you don't have a survey and they find something that a survey would have found, your title insurance won't cover it. Your title insurance will not cover anything that would have been found by a normal survey. I had one gal in class and it was a great example, and I even asked her if I could use it. She bought a house, didn't have a survey, put up a fence along her property line. Turns out she was 4 feet over the property line. She had 100 feet of fence. Neighbor went, had a survey. Guess what? She had to take that fence down and move it. Okay, all at her expense. All at her expense. Okay. And then have the lines redrawn. So there's no way to protect yourself if you don't have a survey. Survey is going to tell you where these properties are. Okay, it's going to be really important. If that survey is wrong, then both title, or they don't have a survey and your property lines are wrong, one side's over the other, you can, both properties will be unmarketable till it's correct. You got to have it corrected. Now hers was a chain link fence. Yeah, it was chain link fence. But what if you put a brick wall up and you're 3 feet over the line? Right? That's real construction work. Now we got to move it 100 feet, right? 100-foot of brick wall. That's real money. Okay. We're going to talk in another chapter. I don't think we're talking about in this chapter about the color of title. All right. So the color of title means that I put the fence up, and when I had my survey done, it said that that fence was on the property line. Well, it turns out there was a mistake in the survey, but I put it up on the information that I had. If I go to close on a property and my attorney makes a mistake and we think that we have ownership of the property, turns out we don't, I only have to have it for 7 years. If I have what's called color of title means that I only have to own this for 7 years because I thought I was the rightful owner. I did everything correct. I had a survey, it was done. I had a closing, it was done. Everything was done correctly. And then it turns out there was a mistake made. I can go to the court and say, hey, here, I have the color of title. This is what they told me. This is why I did it. And then you could lay claim after 7 years. But if you don't have that, it's 20 years. And then you can go and make a claim against the court as an easement by prescription. Again, it's up to the court, and if you known or should have known, or they should have known, yeah. If you're over the fence, over the line, they should have known. Right? So yeah, that would have been it. So certainly have to go to the court. All right, but surveys, super critical. We take surveys for granted. All right, we take surveys for granted. And we can't. We have to make sure that we get those surveys done. It's for the expense of purchasing a house. We need to get that survey done. All right. Now, here's a typical encroachment here. I would have to think that at one time these two properties were owned by family, because in order for that gentleman to build here on this particular section here, I would have to think that I would have had to give him permission to do so. So maybe my dad lived here and I lived here, and I said, all right, we'll share the shed. Now all of a sudden I want to sell this house. What happens? I got an encroachment here, right? I got a problem. We got to tear this shed down. because this is literally attached, right? I got an encroachment. I have a serious encroachment. So that shed has got to go down and get off that property line. Okay? It's the only way that market, that would be, you'd have a cloud on the title if you didn't get this taken care of. Who owns this property and who owns the use of that shed? Right? You have to get that cleared up. We're going to talk about the big kahuna encumbrance. Taxes. Taxes. You, once you get ownership, are required to pay property taxes. Period. Right? Required to pay property taxes. So, property taxes are called ad valorem taxes. And ad valorem means according to value. According to value. Okay? Now, it is the Machinery Act that gives the North Carolina government the right to tax real property. Okay? The Machinery Act says that they can tax real property. All right. So this is a general ad valorem value, which means that they're going to come around and they're going to send appraisers around and they're going to get a value of your property. And that's what you're going to be taxed on in North Carolina. Okay? You're going to be taxed on that. Taxes are local. The state of North Carolina does not tax your property. They tax your personal property, but your real property, they do not. Real property is done by your local county, city, town. Okay, that's who develops these rates. Okay, so everything, unless if you're a nonprofit or you're a church, okay, you don't pay taxes because you have a special exemption. Everybody else is going to pay real estate taxes. Okay. Now, last two keys, last two things on this, two bullets. Every 8 years, the county has to go out and do what's called a mandatory reassessment. They call it an octennial reassessment only because they come out every 8 years. Okay, they come out every 8 years and they do it. So, if in 2020, your property is worth $200,000, 8 years from now, they're going to come back in 2028, and they're going to look at the value. So you're going to be taxed for that $200,000 that they did for the next 8 years, probably, until they come and redo a new one. Now, your property value is probably going to what? Go up in that 8 years. So you're going to get taxed on your assessed value. And that's that 2020 thing that they came around and did. All right? They're going to assess it. What's this house worth? If I was going to pay for it on the open market, what's this house worth? That's what the appraisers would do for every single property. Okay? And that's good for 8 years. 8 years. Now, there's always a fly in the ointment, right? What's happened since 20? All right, let's say the last assessment was 2018. What's happened since 2018 to property values in our communities? They've gone up, haven't they? They've gone up pretty much. Well, what they do have in the law that says that in the event of some sort of change, what they can do every 4 years, halfway through, is do what's called a horizontal reassessment. All right, that doesn't mean we go out and reassess everybody at the new price. What we do is we take your $200,000 assessment in 2018 and everybody's, and all we do is, let's say we think the properties have gone up 5%. Okay, 5% of 200,000 is what? 10,000, right? So now what they can do is take everybody's properties and raise the entire value of everybody by 10%, or I'm sorry, by 5%. So that means that your new reassessment after 4 years could be $210,000. Now, they didn't come out and visit it, but they took everybody's property and they raised it that same level. Okay, because they see the markets going on and everything else, right? And then after 8 years, right, another 4 years can come. And then, so in 2026, using our timeline, 2018, they did the research, they did the assessment. 2022, they did a horizontal increase, made everybody bump up. And then in 2026, they have to go out and check every house again and do the proper assessment. So 8 years is a mandatory reassessment. And they have the right after 4 years to raise everybody horizontally, depending on where property values have gone. Okay, they can reassess it. They don't have to raise it necessarily. They could lower it. You know how that works, right? It works either way. It works either way. Okay, everybody good? Now, the example I use here in this slide, some of you were very, very young in 2006, but the property markets were at their peak in 2006, and then 2007 and 2008, they crashed, and they crashed hard. Prices went down. So what they did in 2010, they had to go back and reassess these properties, because houses that were sold for $200,000 in 2006 were now only worth about $160,000. People were screaming, so they had to go and reassess. Okay, so that's how the rates work. That's how the time works. Okay, any questions on that? Every house is on the same year. Every reassessment is done in the same year. Okay, it's not staggered. Not staggered. Okay, they have to do every one of them same year. Yes, everyone. They have to do a horizontal reassessment on the 4th year. Right? Every piece of property has to move the same way. They're not going to go out and look at individual properties. Everything moves up or down the same way. This is for real property, real estate, right? Not just for land, but your houses and your whatever it is, whole thing, whatever it is assessed on. But yeah, you're going to have to, again, you're going to get a reassessment, horizontal or otherwise. Now, different counties, again, these are local, so different counties may do it in different years, but it depends on your county, and it'll have to be the same continuous. Every 8 years, they must visit and do every house individually, but every 4 years, they can take the whole marketplace and go up and go down. Now, let's think this through here for a second. Do they change your taxes every year? Any of you who've owned a house for a long time? Does your tax rate stay stable for 8 years? No. No, it goes up or down every year. Usually goes up every year. Why? Well, if I only have $10 million in houses, just to use a number, I got to make a budget, right? I'm your county commissioner. I have to pay your teachers more. I have to pay your police more. I have to pay your fire more. I have to pay your first aid more. I have to put another school up. I have to fix roads. I can do all of that stuff. Have those prices all been staying the same or going down over the last 8 years? No, they don't. They go up, right? So what can I move? What can I move that will make me get the money I need to pay my infrastructure? What do you think? I got to move something. Got to make more money. Yeah, you're going to raise your tax rate. You're going to raise your tax rate, right? Because we have to make, we got to pay, I got to pay the cops, right? I need the schools. I need a new firehouse. These things, you'll be more mad if we close the school down, right? So, you know, we need these things. We still have to run it. Schools aren't getting any cheaper, right? We already don't pay our teachers enough. And I'm not talking about me, right? I'm talking about real teachers. The ones who are watching our kids, they don't get paid nearly as much as they should be. Okay, right. Taxes go up in insane amounts in the last 6 months. Well, yeah, because what happens is that you got to pay it. So what was 60 cents per 100 of value last year might be 70 cents per 100 of value this year, because we got to pay, right? We got to get that money together. So that can move, and that's why your taxes move every year, right? We got to do a budget. Sam's looking at the county budget. I'm the county commissioner, and I'm looking at all this stuff, and I'm saying, I can only, if I tax everybody at last year's value, I can only accumulate $5 million in tax revenue. So I can either cut this budgeting or figure out how to make $6 million in tax revenue to cover the gap, right? So what can I do? What's the easiest way to do it? I don't want to lay people off. I don't want to stop funding. I'm going to raise taxes. I'm going to bump up your property taxes. It may not be much. Still a bump. Still a bump, right? That's how they do it. That's how they make their budgets. And that's the thought processes behind why. It's not because they want to punish you every year, believe me. Because as many times as they do that is as many phone calls as they get complaining about they did it, right? It's not something that they want to live through. Does anybody work for a county commissioner's office? Anybody deal with the taxation department? Anything like that? Love to hear from you if you do. Yeah, it's not the easiest thing in the world. Okay, carrying on. So we have this mandatory octennial reassessment every 8 years. We have to do everybody, house by house, property by property. We have to figure out what the market value is at that time, okay? That automatically becomes your assessed value because why? That's that's what you're going to get taxed on for the next 8 years, assuming we don't make that horizontal change every 4 years. But that's what you're going to get taxed on. So you're going. If I bought my house in 2018 and I paid $200,000 for it now and it's worth $225,000 now, well, I'm still getting assessed at $200,000 because that's what they bought. That's what they did until they redo it, and then they'll move it up. Okay, so that's my assessed value. What it was in the last time. All right, and that kind of explains why the assessed value tends to be lower than the market value because it's time, right? Time over time. So North Carolina has a timetable, a taxable timetable. So on the 1st of January 1, 2022, let's use this year because that's where we are. On January 1st, 2022, every house in that jurisdiction had a lien put on it that said they owe real estate taxes for 2022, this year, okay? That gives them 31 days to list all this property, all right, and the values of these properties at that point, right? January 31st, they're all listed. You can go find out what each property is valued at, okay? They have until July 1st to establish the new tax rate. Remember I said we got to earn some more money, so we got to bump up the tax rate, or we don't need so much, we have a surplus, we'll lower the tax rate, okay? Either way, so they have until July 1st. So they have 6 months to come up with a new number. Your bills will go out in August, your tax bills will go out for 2022. And after September 1st, you can pay your taxes. Now, very important to remember, taxes are paid in arrears. Taxes are paid in what's called in arrears. So this is January of 2022. This is December of 2022. At this point, when I make this payment, I am paying for this year. I'm paying backwards. So I get to live here the whole year without paying taxes, and then I owe taxes for this year. Okay? So it's called in arrears. I don't know if any of you have ever heard that, but that's what happens when you pay taxes backwards. Same thing with your interest on your mortgage. You pay it in arrears, you pay it backwards. Okay? Well, believe me, we'll get into that. All right? So that's how this is listed. Okay. Everybody good? Everybody with me? All right. This becomes late. You're delinquent on January 6th of 2023. So you literally have until January 6th of 2023 that if you pay it on the 5th, you're still good. If you pay it on the 6th, you're late on your taxes. Okay? All right. So key date, September 1, key date. Remember I said there were 3 different ways we're going to look at this? That's a key date. Because what happens if we close prior to September 1st? When we go to the closing, can we pay the taxes? No, can't pay the taxes yet. So what do we have to do? The seller's got to give the buyer some money for his share of the taxes, right? Sellers, we got to figure out what the seller owes and then give a credit to the buyer. Seller debit, buyer credit. We'll practice this, believe me. So that's, that's how that works. Got to get the money. If it is, so let's say it's after September 1st. Let's say we're going to close on September 12th. And on September 1st, the seller paid all the taxes for the whole year because he could. We go to closing. Does the seller obligated to pay for the whole year if we close on September 12th? No, the buyer's got to pay his share, right? October, November, December, and then the 18 days left in September. So what? Buyer's got to do what? He's got to pay the seller back, right? He's got to pay the seller back. Buyer debit, seller credit. Everybody good? Everybody get that one? Good, let me mess you up. What happens if it's after September 1st and the taxes have not been paid? What do you think they're going to do? What's the attorney going to do? We're going to close on September 12th and those taxes have not been paid. What do you think? Let's take a guess. You're going to get to both of them and have them pay it at the closing. Yes, right then and there. So that means they're both are going to be debited for their share of the taxes. So that's why you got to watch. That's the three ways it can work. If it's before September 1st, the seller's got to give the buyer credit because he can't pay the taxes yet. If it's after September 1st, right, the buyer, if the seller's already paid the taxes, the buyer has to give the seller his money back because he paid the taxes. Then he doesn't have to pay the whole year. So the buyer gets a debit, seller gets a credit. If it's after September 1st and the taxes haven't been paid, both are going to pay their share of the taxes and they will both be debited. Okay, so the dates are very, very important when we're looking at these problems. All right, so we're always going to have to, and this is called prorations. We're going to get into prorations. This is where we introduce them. There's no way to get around them. We're never going to close, even if we close on the 1st of the year, the seller still pays for that day. If we close on the last day of the year, somebody's going to have to pay for that last day, right? Whether it's interim interest or whether it's taxes or whether it's we can never get away from them. It's never going to work out equally. Okay. So keep that in the back of your mind as we start working through these, as we start churning through this. We got a little bit more to do. All right. Okay. So here is that timeline. Here's that timeline. All right. Everybody gets a lien on the 1st. Now this is for last year, so this goes back, right? If we're still paying, sorry about that arrow, we got hit on there. This is for the year before. So this is the last day that 2021's taxes can be paid. We're doing 2022 here, right? We're going to list all those properties by the end of the first month, January 31st. And they got 6 months to figure out a new tax rate. On July 1st, we get that tax bill. Your taxes are, all right, you're going to pay at a rate of, and we'll talk about rates in a little bit. They'll mail all those in August. And after September 1st or later, we can pay them. We cannot pay them before then. We cannot pay them before then. So we have some from September 1st to January 5th of next year to pay the taxes. 4 months and 5 days. Okay. So this is how the tax data works. And we'll get into a little bit more of this in a second. But let's say in your neighborhood, they put in sidewalks. They built a community pool that we didn't have before. They built a new tennis court. Didn't come out of reserves. Everybody's going to pay their fair share. let's say there's 100 houses in this community, you're going to get what's called a special assessment. Okay. So in our priority of liens, remember the priority of liens we talked about the other day? Real estate taxes were going to be paid first. Special assessments as close to being first as they can possibly get without being first. Okay. So 1 and 1A, property taxes, special assessments, they get paid first. All right. So when something special happens, all right, they are going to, so it says the example when the city or town installs sidewalks, streetlights, other improvements, okay? All of those things, that is a special assessment if you have to pay for it, okay? And this is a superior lien with the exception of real estate taxes, ad valorem taxes. If you are in a restricted community, if you have an HOA and, or, you have, maybe you're in a gated community and it's not county streets. If you're going to put a new sidewalk in, yeah, your community is going to pay for it. Even if they haven't taken the roads and they have private roads in that community and you need to replace a road, the community pays for it. Yeah, not necessarily the city. Okay, so it depends. Yeah, and yes, we had a community along the shore that had houses on the channel, but the channel was tidal. They all had these nice, real nice houses on the channel. But the channel was always got to low tide and they couldn't bring a boat into their docks. So what they wanted them to do was dredge them. The total cost of the project cost each and every homeowner on those channels, and it was about 5 or 6 blocks worth, $2,000 a year for 10 years. And that's what they were assessed. Every year they had to stroke a check for $2,000 because they got these things dredged. And it was not county money, it was their money. They wanted it, they paid for it. 10 years worth of $2,000. Or you can just stroke them a check for 20 grand. I know and the houses are nice there. I still don't want to pay 20 grand for something that, what if I didn't have a dock? What if you lived on those streets and you backed up to the water, whether you had a dock or not, you paid the 20 grand. So what if I didn't have a boat? What if I didn't care? Still got stroked. Still got to stroke that check. So it's not necessarily fair, but that's the way they do it. Mm-hmm. All right. And our trustee would own it, not Tiger. There you go. Our trustee would own it. Okay. So that's special assessments. All right. Let's look at this. All right. Annual taxes. If we talk about annual taxes, this is how much total property taxes due for a specific period, specific property. It can be calculated as annual or monthly. In most cases, we're going to look at it annually. And if we come up with an annual number, how do we do monthly? It's easy. Divided by 12, right? That would be 1 month. All right. Now, this is time to bring this in, and I hope it's going to make your life a little bit easier. For purposes of this class and purposes of the North Carolina real estate examination, every year we'll have 360 days. Every year you'll have 360 days. Yes, that's right. Normally they have 365. Every year is going to have 360. So if I divide that by 12, every month has what? Every month has 30 days. February included. December included. Okay? So for mathematical purposes in this class, unless and we won't, so maybe if you're taking the national portion of the exam at PSI, they might ask you for something that says calendar days, then you got to use the actual calendar. But for purposes of this class and for purposes of the state portion of the test, it is 30 days per month, 360 days a year. That's all you need to know. All right. So you don't have to worry about January being 31 and February being 28 and March being 31. Right. And no, you have to go back and remember that silly little poem they taught you in 3rd grade. 30 days past September, April, June, November, all the rest have 31, except for February, which has 28. Right? So whatever way it takes to figure that out. So 30 days a month, 360 days a year. So that's going to make your life easy. The assessed value is what the tax rate, what they say, right? Your house is worth $210,000. Your house is worth $240,000. Every 8 years, they're going to come back and they're going to say that. Now they're going to charge you. They're going to charge you per $100 worth of value. So if I'm going to charge you 45 cents per 100, if I have a house that's worth $200,000, what's going to be my tax rate? Well, I can do one of two things. The first thing is I got to figure out it's per 100. So I can take that 100 and divide it into this and come up with a number, right? And that would just give me with 2,000 and multiply 2,000 by 45. And that would be 0.45, and that's going to give me my taxes, right? $900 a year. Or what I always do, get your calculators out. Take 0.45 and divide it by 100. And I'm willing to bet, without a calculator, it's going to come out to this. Take $1.63 and multiply it by 100, or divide it by 100, I'm sorry. And I'm willing to bet it's going to equal 0.0163. I'm no big mathematician, but I know that if I divide something by 100, all I got to do is move the decimal places 2 places to the left. And then multiply it by my whole number. Now I'm not worried about that big number. Is everybody seeing what I'm doing here? Everybody kind of getting this? If I'm giving it, all I want to do is take that number, wherever that decimal place is, all right? Wherever that decimal place is, 0.565 per 100. Well, I'm just going to move this 2 places over and add 2 zeros. And this is going to be 0.00565. Forget about that 100. I'm going to multiply it by my 200,000, and I'm going to get my tax rate, whatever that is. If it's per 100, I'm going to move the decimal place 2 places to the left. Now, if it is per 1,000, anybody want to take a guess what I got to do with that decimal place? I'm going to move it 3 places to the left. Yeah, absolutely. That's all I'm going to do. And then multiply it by the whole number. It's just easier that way. There's no math involved. I'm just moving the decimal point, right? That's all I'm doing. Make your lives easier. I'm trying to help. Trying to help, right? So yeah, those are, I just threw those out to show you that it'll work with anything. If I have 2.625 per 100, right? Really all that is, that per means is by divided. So if I divide this, I'm just going to move that decimal point. So it would be 0.02625 times whatever my house value was. And that's going to give me my tax rate, whatever that is. We're going to practice it. I promise. I promise we're going to practice it. Does anybody know how to do the magic T? What's called the magic T? Let me start my math statement here. I'm going to show you how to do stuff. If your way is better than mine, please don't use mine. Right? If your way is better than mine, and you can do yours, it's something that's easier for you to figure out. There are 100 different ways to figure out these problems. And they all come back to the same place. As long as we get the same answer, I'm not going to grade your work. Right? So I am just flipping that out there so that you understand that I'm going to show you one way, and hopefully it's an easy way. I'm not trying to make it hard, right? But again, you want to make sure that you can prove your work. All right. All right. Now, if I have, let's look at this T here. Okay. If this is a partial number, let's say this is a partial number. All right. And this is a whole value. It'll make sense in a second. And this is our percentage or our return on investment, okay? Or profit percentage or capitalization rate, okay? All of those things. This is always a percentage, this number. If I take a number, let's say 500,000, and I multiply it by some percentage, let's say for argument's sake, 10%, it's going to come to what? Multiply 500,000 times 10%. It should come to 50,000. Everybody agree with me for now? All right. Now, so this is a multiplication across the middle. If I take that 50,000 and I divide it by the whole number, 500,000, how much is that? 50,000 divided by 500,000 should give me 0.10, 10%. 10%. Now, gives me the other one. Now, take your 50,000 and divide it by 10%, 0.10. 50,000 divided by 0.10. I'm willing to bet it gives me that number. So do you see how these things run concurrently? So, long story short here, if we have a T and we have a percentage and we have a partial, some part of a whole, we can figure out the whole. Or if we have a part of a number and we can figure out a whole, you all do it. Yeah, everybody does it. If I told you that you were getting, let me think, prices of eggs were $5 a dozen last week. And they're pretty close now, believe me. And this week you went in and they were $5.50. What would be the increase? What would be the increase? It would be a 50-cent increase on $5, would it not? What would be the increase? 50, right? So it's 50 cents, which is 0.5. This is 5.00. What's the percentage? It would be what, a 10% increase? Yes? You do it every day in the grocery store. We're not asking you to do anything else, right? If I told you that the price of your house is worth 10% more than it was last year, what would I do? I would go in there and I'd say, all right, look, forget about that. Last year it was worth 265,000, but now it's 110% of some number, what it was, right? 110%. If I divide that up, I'm going to find out my new value. I'm just using this t-square here. I'm not changing anything, right? If I took the last year's price and I multiplied it by 110%, it should give me this.
If you like this video, feel free to share it with a friend. For more real estate education content, please subscribe to the channel. From all of us at Seacoast Real Estate Academy, thank you for watching.